Before you buy an investment property, before you submit an offer, before you negotiate price, before you calculate cash flow, and before you start imagining rental income, there is one step you need to take seriously. Obtain financing pre-approval. And I want to be very clear from the beginning. A pre-approval is not just a piece of paper. It is not just something your realtor asks for. It is not just a document you attach to an offer. A serious financing pre-approval helps you understand what you can realistically buy, what loan options may be available to you, how much cash you may need, what your estimated payment may look like, and whether your investment strategy actually matches your financial ability. In real estate investing, financing is not a side issue. Financing is part of the deal. A property may look good. The rent may look strong. The location may look promising. The future value may look attractive. But if the financing does not work, the deal does not work. That is why serious investors do not wait until the last minute to speak with a lender. They understand the financing before they chase the property, because the property is only one part of the investment. The loan, the payment, the cash needed, the reserves, the interest rate, the terms, and the approval conditions are also part of the investment. So let's break this down in a detailed but straight-to-the-point way. A financing pre-approval is when a lender reviews your financial information, like your credit, income, and assets, to estimate how much you may be able to borrow. But this is very important. Pre-approval is not final approval. It's a strong first step, but it means you may qualify under certain conditions. Final approval comes much later, after the property is under contract and all loan conditions are satisfied. A smart investor asks, what are the conditions behind the approval? Because those conditions can affect the deal. Let's clear up a common misunderstanding. Pre-qualification and pre-approval are not the same. A pre-qualification is a basic estimate based on information you provide. A pre-approval is stronger. It means the lender has actually reviewed your credit and documentation. For investors, this difference matters. When competing for a property, sellers want to know your financing has been reviewed. A strong pre-approval makes your offer more credible, and in real estate, credibility matters. Many beginner investors do this backwards. They find a property, get emotionally attached, and then speak with a lender. That is a mistake. You don't want to fall in love with a property your finances cannot support. A pre-approval protects you from wasting time and making emotional decisions. It tells you what lane you should be driving in. Pre-approval gives you boundaries to shop strategically, not emotionally. A serious investor chases the right property within the right financial structure. Buying power isn't just the property price. It's what you can realistically purchase based on your financial profile and available loan terms. It's affected by your credit, income, debt, and down payment. This is why two investors can look at the same property with different results. Pre-approval helps you understand your buying power before you shop. But a warning, your maximum approval amount is a ceiling, not a target. A beginner asks, how much can I borrow? A serious investor asks, how much can I safely carry? That is a completely different mindset. A serious pre-approval requires documentation. While the exact list varies, lenders commonly request documents like pay stubs, tax returns, and bank statements.
Why? Because lending is risk analysis. Income shows ability, credit shows history, and assets show reserves. The documents support your story, and your file needs to make sense.
Mismatched information raises questions. The pre-approval process helps you understand how a lender sees your financial profile, so you can fix problems before you're under contract. A pre-approval can help you avoid bad deals because financing exposes reality. Many investors analyze properties using rough numbers. They estimate the mortgage. They estimate taxes. They estimate insurance. They estimate closing costs. They estimate repairs. They estimate everything. But estimates can be dangerous when they are too optimistic. A lender can help you understand what the financing may actually look like. The interest rate may be higher than you assumed. The down payment may be larger than you expected. Closing costs may be higher. Reserve requirements may apply. Property taxes may affect the payment more than expected. Insurance may be more expensive than expected. The lender may not allow certain income to be counted. The property type may require different financing. A condo may have project approval issues. A multifamily property may require stronger reserves. A mixed-use property may need different loan terms. A fixer-upper may not qualify for standard financing unless repairs are addressed. All of these things can change whether the deal works. That is why pre-approval is part of due diligence. It helps you avoid making offers based on fantasy numbers. Real investing requires real numbers, and financing is one of the most important numbers in the deal. Not all investment strategies require the same financing. A loan isn't just a loan. Financing must match the strategy. For example, a buy-and-hold strategy needs long-term, fixed-rate financing, while a fix-and-flip requires a short-term loan that matches the project timeline. If your goal is BRRR, you need to understand both the purchase financing and the refinance plan before you buy. Pre-approval isn't just asking, "Can I buy something?" It's asking, "Can I finance the property that matches my strategy?" If they don't align, the deal can collapse. You don't need to be an expert in every loan, but you should understand the major categories. Conventional loans are common for residential investments but have stricter guidelines. Government-backed loans like FHA and VA are for primary residences but can be used for house hacking. DSCR loans focus on the property's rental income, while hard money is short-term financing for flips. Commercial loans apply to larger properties, and portfolio loans held by the bank may offer more flexibility. The key is that the financing must fit your strategy, which is why early lender conversations are so important. Another major reason to obtain pre-approval is to understand how much cash you actually need. Many beginners focus only on the down payment. But the down payment is not the only cost. You may also need money for closing costs, inspections, appraisal, attorney fees if applicable, title costs, lender fees, prepaid taxes, prepaid insurance, escrow accounts, repairs, reserves, utility setup, initial maintenance, property management setup, possible vacancy after closing, and renovation funds if the property needs work. This is where investors get into trouble. They save enough for the down payment but forget about everything else. Then they close with almost no money left. That is dangerous. Because once you own the property can start demanding money immediately. A water heater can break, a tenant can move out, a roof leak can appear. A city inspection can require repairs. Insurance can increase, taxes can change. And if you have no money left after closing, a normal property problem can become a financial crisis. A good pre-approval conversation should help you estimate total cash needed. Not just purchase price, not just down payment, total cash needed.
And after that, you need to ask, how much cash will I still have left after closing? Because if the answer is almost nothing, the deal may be too tight. A serious investor does not only focus on getting in, a serious investor focuses on staying in.
A pre-approval can make your offer stronger. When a seller receives an offer, they are not only looking at price, they are also looking at the likelihood that the deal will close. A higher offer with weak financing may be less attractive than a slightly lower offer with stronger financing. Why? Because sellers do not want uncertainty. They do not want to take the property off the market for a buyer who may not qualify. They do not want delays. They do not want financing surprises. They do not want the deal falling apart weeks later.
A solid pre-approval tells the seller, this buyer has spoken to a lender. This buyer has been reviewed. This buyer is more serious. This buyer may be capable of closing.
Now, a pre-approval does not guarantee that the seller will accept your offer, but it improves your credibility. And credibility matters, especially for investors. Because investors often compete with owner-occupants, cash buyers, experienced investors, and buyers who are already prepared. If you are not prepared, you may lose opportunities before you even begin. Speed matters in real estate. Good investment opportunities do not always sit around waiting. If a good deal hits the market and you are not pre-approved, you may lose time. You call a lender. You submit documents. You wait for credit to be reviewed. You wait for income to be reviewed. You wait for a letter. Meanwhile, another buyer may already be ready. That buyer may submit a strong offer while you are still gathering paperwork. Pre-approval allows you to move with confidence. You already know your lane. You already know your financing options. You already know your estimated cash needed. You already know what documents have been reviewed. You already have a letter ready. Now you can focus on the deal. But without pre-approval, you are reacting. And serious investors do not want to react. They want to be ready. Sometimes pre-approval reveals problems. That is not a bad thing. It is better to find problems early than late. Maybe your credit score is lower than you thought. Maybe your debt-to-income ratio is too high. Maybe your income cannot be counted the way you expected. Maybe your tax returns show less income than your actual cash flow. Maybe you need more reserves. Maybe your down payment funds need to be seasoned. Maybe a large deposit needs documentation. Maybe a recent job change creates questions. Maybe the loan program you wanted does not fit your strategy. These problems can feel frustrating, but they are useful information, because once you know the problem, you can work on the solution. Maybe you need to pay down debt. Maybe you need to improve your credit. Maybe you need to save more money. Maybe you need a different loan product. Maybe you need to adjust the purchase price. Maybe you need to wait a few months. Maybe you need to choose a lower risk property. Maybe you need to change the strategy. That is not failure. That is preparation. A problem found before contract is a lesson. A problem found after contract can become expensive. Once you are pre-approved, you need to protect your approval. Do not assume that because you received a pre-approval, you can now do whatever you want financially. Do not open new credit cards. Do not buy a car. Do not finance furniture. Do not take out personal loans. Do not quit your job. Do not change jobs without discussing it with your lender. Do not make large unexplained deposits. Do not move money around without tracking it. Do not co-sign for someone else. Do not increase credit card balances. Do not miss payments. Any of these things can affect your approval. Your lender may check credit again before closing. They may verify employment again. They may review updated bank statements. They may discover new debt. And if your financial picture changes, your approval can change. Mira, mira. Do not sabotage your own closing. Once you are pre-approved, your financial job is to stay stable. Protect the loan. Protect the approval. Protect the closing. When you speak with a lender, do not only ask, "How much do I qualify for?" That is not enough. Ask better questions. Ask, "What loan programs fit my investment strategy? What down payment is required? What are the estimated closing costs? What reserves are required? What interest rate range should I expect? How does my credit score affect the rate and pricing? Does this loan allow investment property? Does this loan allow multifamily property? Can rental income be used to qualify? How is rental income calculated? Are there limits on the number of financed properties? Are there property condition requirements? Would repairs be required before closing? Are there seasoning requirements if I plan to refinance? What happens if the appraisal comes in low? What documents do you need from me? What could delay approval? What should I avoid doing before closing? These are investor questions. You are not just trying to get a yes. You are trying to understand the rules of the game. Because once you understand the rules, you can make better decisions. This is important. A pre-approval tells you what you may be able to finance. It does not tell you what a property is worth. It does not tell you that a deal is good. It does not tell you to overpay. It does not replace analysis. It does not replace due diligence. It does not replace inspections. It does not replace reviewing rents, expenses, taxes, insurance, repairs, or market conditions. Some investors get pre-approved and treat that number like permission to spend. That is dangerous. A serious investor treats the pre-approval as a tool, not a command. Just because you are approved for a certain number does not mean every property at that number is a good investment. You still need to analyze the deal. You still need to verify the numbers. You still need to inspect the property. You still need to understand the market. You still need to know your exit strategy. You still need to protect your reserves. Pre-approval gets you in position. Analysis tells you whether to move forward. Do not confuse the two. Before you start submitting offers, before you spend hours analyzing properties, and before you emotionally attach yourself to a deal, obtain financing pre-approval. Understand your loan options. Understand your buying power. Understand your estimated payment. Understand your down payment. Understand your closing costs. Understand your reserve requirements. Understand how the financing fits your strategy. And understand what you can realistically carry. A pre-approval is not just a letter, it is a financial reality check. It helps you shop with discipline. It helps you make stronger offers. It helps you avoid wasting time. It helps you identify problems early. And it helps you protect yourself before you take on the responsibility of owning an investment property. Remember this: a serious investor does not shop first and figure out financing later. A serious investor understands the financing before chasing the deal. Because if the financing does not work, the deal does not work. I highly recommend you take a real estate licensing course in your state. I cannot emphasize this enough. It is to your advantage personally and professionally. Even if you never become a practicing real estate agent, the knowledge you gain can help you understand contracts, agency, disclosures, ethics, financing, property law, fair housing, negotiations, timelines, and the overall transaction process. That knowledge can make you a more educated, more confident, and more prepared investor. This is step 3 of becoming a smarter real estate investor. Obtain financing pre-approval before you buy. Because when you understand your financing, your buying power, and your limits, you stop guessing. You start moving with discipline. And discipline is what separates a hopeful buyer from a serious investor.